We often hear that Islamic banking faces a high rate of failure. Islamic banks expose shareholders to a magnitude of losses that is not that common in conventional banking, or similarly, that Islamic banking is not a good business model. So this video will go over these concerns and try to understand their origin and how Islamic banking mitigate these risks. General perception or major concern that people have about Islamic banking was once summarized by an economist from Duke University who said, Islamic banking is based on an operational principle of profit and loss sharing. That is simply unfeasible. Similarly, Hans Weiser once summarized in his book titled Islamic Finance, Principle and Practices. He says, Islamic finance comparing to conventional banks present some disadvantages, more risk for depositor, higher cost, and principal agent problem, inadequate financing, limited supply, insurance with pitfalls, less scope for diversification and hedging. Another similar statement was published in Journal of International Financial Markets, Institutions, and Money. The results of hazard and survivor function indicate that Islamic banks have a higher incidence rate of failure. The challenges that Islamic banks face in day-to-day operations are strong incentive for clients to report lower profit. The higher the declared profit, the higher is the share of the bank. This puts the use of profit and loss sharing at a disadvantage to fixed income models for a bank. The profit and loss sharing is not suitable or feasible in many cases, such as short-term resources requirement, working capital, non-profit generating projects such as education and health sector. In some countries, interest is considered a business expense and given tax exemptions, but profit is taxed as income. Thus, clients of the business who obtain funds on a profit and loss sharing basis have to bear the financial burden in terms of higher taxes, as opposed to the companies who pay interest. Mudarba, one of the forms of profit and loss sharing, provides limited control rights to the shareholders of the bank and creates an imbalance in the governance structure. This is where the Islamic banks invest and then get a voting right in the joint venture or the company they invest funds in. And this gives Islamic banking a control over some operational or some strategic decisions of the company. Another challenge or concern that people have is that although Islamic banking forbids interest, its profit rates often are benchmarked against the interest rates. Most Islamic banks have their own Sharia boards ruling on their bank's policies. These separate or individual Sharia boards result in interpretations of Sharia which may differ from board to board. Another challenge that Islamic banks face is the competition. The conventional banks are firmly established and have experience or rules or principles, policies and procedures established over centuries. Islamic banks are not yet sure of their policies and procedures, and then because of Sharia compliance, they feel restrained in taking unforeseen risks. Conventional banks, because of their operational efficiency and processes developed over centuries, are able to operate at much lower cost. There are some going concern challenges that people perceive about Islamic banking. Since investment or finance is not a loan but a profit and loss sharing, so as opposed to conventional banking, the potential of the loss is quite material. So in terms of impact and probability, the probability of a company or a recipient of funds incurring loss is almost same whether it's conventional banking or Islamic banking. Is the impact. Conventional banking limits their impact through securitization, through having assets against which they extend the loan, or personal guarantees. They have commitment to get their principal back at a fixed or variable interest rate, as opposed to Islamic banking. Islamic banking invests based on profit and loss sharing. Principal is not guaranteed. A conventional bank will receive loan principal and interest back in case of a loss, and in case of bankruptcy will recover as much as possible through liquidation of secured assets. In case of Islamic banking, the loss is shared based on the terms of the agreement that leads to higher impact for Islamic banking as opposed to conventional banking. Key differences between the two banking systems will help us understand the difference between the risks that Islamic bank face as opposed to conventional banking. So material risks that Islamic banking face, which are different than conventional banking, lie in the investment side, which are, in case of conventional banking, lien, security, and commitment ensured that principal and interest are paid back to the conventional bank. So the lending is secured and income is confirmed unless the business goes down to that extent that they have to file bankruptcy. That conventional bank will opt for liquidation and get as much as they can. As opposed to Islamic banking, principal is not guaranteed, profit is not guaranteed, and in case if the investment or the joint venture, the losses are shared per the terms of the original agreement. Principal is not guaranteed. And that's where people perceive rightfully that Islamic banks are exposed to a higher risk. Considering the extra risks that Islamic banks are exposed to as opposed to conventional bank, the risk mitigation practices need to be much higher and much more strict. A higher number of extensive controls on investments. We need to understand that Islamic banking is not letting its finance seekers use its spare funds for their needs at a specific rate for a specific time. Islamic banking is actually investing to be part of the business, and that's where the key difference is. And that's where the risk of Islamic banking differ. And people perceive rightfully that it's much higher than conventional banking. That doesn't mean that Islamic banking is not a feasible business model. In a simple terms, Islamic bank invest as partner while conventional bank offer loans. Require extensive and much higher mitigating controls for Islamic banking. And that's where some may say that business model is not viable. But then again, how can we say that for Islamic banking, but not for venture capitals or investment companies, which invest in business as partner or against equity or shares in the company and not basis of the interest, which is similar to Islamic banking. First Islamic bank as a test started in 1950s. However, the first Islamic commercial bank started in 1970s. The Dubai Islamic Bank is second largest Islamic bank as per 2019 data, and is complying with Sharia, provide almost all services as conventional banks offer, and has been flourishing. They have branches across Middle East, and this is just one example. There are numerous banks with extensive branches and millions of customers across the world, or at least across the Islamic world. And these banks are there for years now. General perception of finance experts and regulators is the same, as that these are high-risk businesses. Some regulators still treat it as a high-risk venture and opine that soon these banks may spend their shareholders' fund and then go bankrupt. The risk is true for any other financial institution, especially venture capital or investment banks, just like I mentioned earlier. It's just that these banks follow Sharia and do not extend loans or deal in prohibited businesses. It's a matter of understanding the nature of businesses. If bank management is not competent or does not do adequate due diligence, any bank, conventional or Islamic or any other business for that matter, can fail, is bound to fail. And that's where the risk is. If Islamic banking follow profit and loss sharing principle and does not invest in certain businesses, such risks are mitigated through having a proper due diligence when they invest. Rather than generalizing that all Islamic banks have higher rate of failure or not a feasible business model, is a matter of understanding that those banks that they fail is a matter of their management, the way they run their businesses. There are simple successful examples in Islamic banking and conventional banking, and there are similar failure examples in Islamic banking as well as in conventional banking. Another one I would like to mention that Islamic banks are less efficient, have higher intermediation ratios and higher asset quality, and are better capitalized. The latter two indicators in particular have helped Islamic banks outperform during the financial crisis. I will conclude this session with the words of Professor Ibrahim, and he said, Islamic finance is still in its early stages of development and is still beset by tensions and problems. Thank you very much for watching. If you have any questions, comments, please send us an email and subscribe to our channel for future videos. Thank you very much for watching.